Welcome to your daily market briefing for August 18th, 2026. Today, we're breaking down a session defined by global tensions, structural stock shifts, and some highly specific sectoral pain. We're cutting straight through the noise to bring you exactly what you need to understand today's tape. So let's dive right into this explainer and get you prepped.
Here's your top-down agenda for today's session: market benchmarks and expiry, the crude macro reality, top movers and shakers, street scuttlebutt, and rumors, and then we'll wrap the whole thing up with tomorrow's trading playbook.
Let's kick things off with Section 1, Market Benchmarks and Expiry.
The drag across the board was just relentless today. The Nifty 50 closed down 0.55% at exactly 24,155. That's a drop of 133 points, officially marking its sixth consecutive down day. Over on the BSE, the Sensex closed at 77,235, shedding 493 points, or 0.63% for its third straight session in the red. But the real story here is the market breadth beneath those index numbers. In the Nifty 50 today, we saw a dismal 11 advances against 39 declines. It was a broad-based slow bleed, led lower primarily by IT and realty.
Now, looking at the derivatives data, today was Tuesday, which meant the NSE Weekly Index Options expiry for the Nifty. The Nifty max pain hovered right at 24,200. Looking ahead a bit, the Bank Nifty monthly expiry is rolling into August 25th, with its max pain currently sitting at 57,600. And speaking of expiries, please note that the Sensex now runs its very own weekly options expiry on Thursdays, because, well, apparently traders looked at the calendar and decided they needed just one more day of maximum pain in their lives.
So who's actually buying and who's selling in this environment? Looking at the most recent flow data from August 17th, foreign institutional investors were net sellers to the tune of about 2,535 crore rupees. But look at the domestic side. Domestic institutional investors aggressively bought 5,102 crore rupees. The absolutely crucial point here is that this robust domestic bid is acting as a massive shock absorber. It's literally the concrete floor keeping the market from falling completely through the basement under this heavy, persistent tape of foreign selling.
Moving right along to Section 2, the crude macro reality.
$91 a barrel. This is the single number that matters most on your screens right now. Brent crude has dramatically spiked, crossing that $91 mark. This isn't just a slight tick upward, either. This is the third straight up session for crude, and a surge of this magnitude sends immediate shockwaves through inflation models and equity valuations worldwide.
So why the sudden spike? Well, geopolitics is completely dictating the price action right now. 60 days ago, a temporary memorandum of understanding was struck between the U.S. and Iran. Yesterday, that MOU officially expired and President Trump declined to extend it. The immediate real-world consequence? A massive surge in war risk premiums. Today, we're seeing tanker attacks drastically slow down shipping lanes. Tanker transits through the highly critical Strait of Hormuz plummeted from 31 vessels just a week ago to a mere 5 over the weekend. That is a massive supply chain bottleneck happening in real time.
What does a $91 barrel mean for the actual market? It creates an immediate, bifurcated tape. It massively pressures oil marketing companies, the aviation sector, and paint manufacturers who rely on crude derivatives. Conversely, it provides a massive tailwind for upstream producers like ONGC and Oil India. Plus, this completely muddies the global inflation path. Just as markets were getting comfortable leaning towards a September rate cut, this fresh crude-driven inflation impulse hits right before new Fed Chair Kevin Warsh is scheduled to give his highly anticipated first keynote at the Jackson Hole Symposium from August 27th to the 29th.
Section 3. Top Movers and Shakers. Look at the sheer contrast in the F&O space today. On one side, we have Tube Investments, TIINDIA, surging a massive 7.94%. On the exact opposite side of the spectrum, SBICARDs plunged by 4.17%. Now, these aren't just random moves. They represent two very different types of market action. One is driven by intense speculation, while the other is being dragged down by deteriorating fundamentals.
Let's unpack that SBICARD's plunge first. I need to be clear here, this is not just a one-day wobble. The weakness is entirely structural. We're seeing major brokerage caution regarding the turning of the unsecured credit cycle. Card delinquencies are rising, and net credit costs are elevated. Combine all that with fierce competition in the premium card segment from aggressive private banks, and top it all off with the looming overhang of a potential MSCI deletion. Honestly, it's a perfect storm of fundamental headwinds pushing this stock down.
Looking at the rest of the board, the gainers were highly idiosyncratic today.
Bosch gained 3.75%, MCX was up 3.64% on strong exchange volumes, and L&T Finance moved up 3.21%. It was a very narrow stock-specific advance. The losers, however, were entirely predictable given the macro tape. Rate-sensitive and consumption-heavy stocks took a real hit. INOXWIND dropped 4.07%, OBEROIRLTY fell 3.78%, and Colgate-Palmolive slid 3.11% on post-Q1 brokerage caution. When crude shocks the system, rate-sensitive, realty, and consumption are almost always the first to bleed.
Moving into Section 4, Street Scuttlebutt and Rumors.
The biggest question floating around trading desks today was, what exactly is driving tube investments? The stock didn't just go up nearly 8%, it did so on 11 times its 2-week average volume. There was absolutely no exchange announcement, yet Telegram groups and trading forums were lighting up like a Christmas tree. The price and volume action strongly suggest that institutional players are positioning for a potential value-unlocking demerger, or maybe a massive strategic block deal. Remember, treat this as unverified, but a volume surge of this magnitude usually means something significant is brewing under the surface.
Beyond TIINDIA, the retail whisper networks were highly active on a couple of perennial favorites. Vodafone Idea saw a 3% bump on recurring, albeit low probability, buzz about a fresh fundraise or a coordinated tariff hike. It really remains the ultimate retail lottery ticket stock. We also saw increased chatter around BML and other public sector undertakings. With the government's aggressive FY26 stake sale push, especially following the recent LIC discount sale, forums are wildly speculating on the next strategic disinvestment targets. If true, it means a near-term supply overhang for any named PSU, but a potential re-rating if a clean strategic sale actually goes through.
And finally, Section 5, tomorrow's trading playbook. Let's get you set up for the next session.
For the options traders out there, here are your exact open interest levels heading into tomorrow. On the Nifty, for the upcoming August 25th expiry, the highest call open interest, giving us our resistance ceiling, is squarely at the 24,200 level. Your immediate support, based on put open interest, is sitting tightly at 24,150. Over on the Bank Nifty, we're seeing a massive straddle building at the 58,000 level, which currently holds both the highest call and put open interest. Make no mistake, that 58K mark is going to be an absolute battleground.
You also need to keep a very close eye on corporate actions. We're walking right into a major ex-dividend cluster. Heavyweights like HAL, delivering roughly 15 rupees per share, RVNL at 1 rupee 72 paise, and Coal India, along with a dozen others, will all go ex-dividend on August 21st. That makes August 20th, your very next session, the crucial come date to qualify. As always, don't just take my word for it. You must verify these ex-dates and record dates directly on the NSE or BSE before executing any dividend capture strategies.
Our idea in focus, based on today's macro tape, is a long look at ONGC. The rationale here is incredibly straightforward. This upstream PSU acts as a high beta proxy to crude prices. As long as Brent sits above $91 and the war risk premium in the Strait of Hormuz holds, ONGC enjoys a massive realization tailwind. But be warned, the risk here is binary and severe. Any sudden geopolitical de-escalation between the US and Iran will collapse that crude premium instantly, and this trade will reverse just as fast. It is a pure geopolitical catalyst play through and through.
Before we wrap up, the mandatory and uncompromising reminder. Everything discussed in this explainer is personal research intended purely for educational purposes. This is absolutely not investment advice. The markets are volatile, and the risks are very real. Always do your own homework and consult with a registered financial advisor before placing any trades.
So, the ultimate question for tomorrow is this. Will domestic institutions continue to absorb this relentless foreign sell-off, or will $91 crude finally break the concrete floor? If you found this breakdown valuable, the ultimate productivity hack is right in front of you. Subscribe and smash the bell icon right now. By doing that, you skip the endless doom scrolling on financial websites, and you can skip the noisy TV news panels entirely. We distill the data down so you don't have to. Have a great evening, manage your risk out there, and we'll see you right back here tomorrow.